What's good, everybody? Welcome to the Doe Show. Happy Monday. Hope you're having a good day. Hope everything's working, right? Just seems like one of those days where things should go wrong, but everything's going really well. So I hope you got some rest. I sent a note out to customers yesterday. I've been doing that the past couple Sundays, just some tips, interesting things about the market, detailed stats maybe, just so people that don't have a lot of time to sort of check in can at least see where the markets are at very quickly if you can't watch the shows that we do, and that's okay. And so I mentioned yesterday that today's Doe Show was going to be rather in-depth, rather geeky, so I hope you guys got a lot of rest over the weekend, because if I could just dive in for a second, I want to show you a different way about about creating a portfolio. You have the stock market lower on the year, of course the S&P lower on the year almost ending, right? So we've only got a couple weeks left to go. Most people are starting to make their holiday plans. And so a lot of people, you'll see this on the media, by the way, a lot of people will start shifting towards their New Year's goals. Now, if you're watching this for the first time, we are financial advisors. We manage retirement accounts. We build and manage our own portfolios here at Jazz Wealth. We are SEC fiduciary registered financial advisors, to say the least. And I would think by the end of the week, one of our videos is actually going to be a special goal that we've hit. We'll certainly bring that to you. But if you're interested, if you need help with your retirement, you've got an old 401k, you want to transfer your account, you don't have time to manage your account, want somebody to do it for you, I hope you'll check us out at Jazz Wealth. Well, here's the thing. As portfolio managers look into next year, they've got some choices. See, the stock market is basically sold off since October now, early September, depending on what sector you're looking at it. And now you have some choices. You can go with the strength, right? And so what you'll see on like CNBC and Bloomberg, they'll have the fund managers on. They rarely come on TV and make a big deal out of this. They'll have them on and say, for 2019, what are you doing? Promise you, they're going to go in two different directions. They're going to either say utilities and healthcare is what they're going after, things like that, or they're going to say financials and tech. Now, there's a reason for that. The reason is utilities and healthcare, best performing areas of the market by far. Doing great. Well, doing great compared to everything else, right? So those are the fund managers that look for strength and they try to piggyback on that strength. Totally fine. Trend followers. On the other side, you're going to have people that look for discounts, and that would be the banks, right? The banks are down 20% on the year. That would be your tech stocks. You've seen the clobbering they've taken lately. And so you will have those fund managers that say that is a depressed discount, therefore it's a value trade. It's a way to get in and get a good value relative to what history tells them or their statistics. So what I thought I'd do today is show you how they sort of dig through and do that. Now, we'll do another one on the trend side of things, utilities and healthcare. We're going to do today the discounted sector because I get more questions from people about, has this stock fallen enough? Should I try to buy it? Is this trading at a discount? Should I try to buy it? And so I wanted to focus on that side first. We're going to get into some geeky details. I hope you're ready. We have on the blackboard here, let me see if I can just kind of cut over to it real quick without messing things up. Yeah, okay. In the S&P 500, this is as of yesterday, so it's going to be a little different today. There are 281 names in the red for the year in the S&P 500. 184 of them are down 10%, and 104 of those names are down 20%. So there you go. A third of the S&P 500 officially in correction territory. 104 of names in the S&P 500 officially in bear market territory. That doesn't really help you in any way. It doesn't explain anything in great detail, does it? I mean, does that give you any sort of idea of what's going on? Well, it does if you start digging around a little deeper. Of all the names that are down on the year, 71% of them are large cap stocks. It's just another way of saying, hey, if you're an aggressive investor, you're investing broadly, you're invested for growth, you're invested in the big names that are out there, you found it rather difficult this year, right? If 71% of all the stocks declining are the large cap stocks, aggressive investors, moderate growth investors, aggressive growth investors, you guys are all just probably negative as well, by a little bit, 6%, maybe 8% at the most, if you're really aggressive. Okay, so that's not opportunity, right? How do we build something going forward out of that? What do we find? Well, if we dig into all of that, we'll go back over here, we find that 22% of all the decliners this year are in the financial sector. So if you were to break down all of the losers and go, who's losing? Who's the worst out of the group? It's the financial sector. So like I said, 22.1%, where 62 of those names are down on the year in the financial sector. So what can we do with that? Well, we realize that is the most depressed area of the market, offering a handful of names, 62 to be exact, that we can sort of play with. Now, out of all of those financial stocks, the one down the most is down 50%, right? Just over 50% today. And the one down the least is actually Aflac. It's only down 1.5% on the year. So inside of this financial sector, right, we started with the overall losing stocks. This would be like a fund manager that says, I want to buy a discount. So this is what they're doing. Find me all the weak stocks. Find me all that are in bear market or correction territory. From there, give me some sort of detail as to how it breaks down sector by sector, and then they hone in on one of the weaker areas. Now, if you were to do this, let's just try something here. You might look at that and go, this guy's nuts. I am not buying the weakest sector in the market. True, you probably shouldn't buy the weakest sector in the market, but could you put together a basket of stocks that was a good value, right? That gave you an opportunity should things start to recover. You can, and this is how the fund managers do it. So they're going to look at that and say, okay, 62 names in the financial sector. Totally cool. What happens if we put those together? Let's just do an easy one. Let's buy all 62 stocks, equal weighting, meaning we're going to buy the same dollar amount or same percentage of all 62 stocks. Let's say you had $100,000, you're going to do about $1,600 and some dollars for each one of those stocks, right? And what would you get? Is that worthwhile? Should you buy that? Now, inside of those 62 stocks, by the way, in the financial sector, it's very diversified. It's not just Goldman Sachs, right? You got the big banks, you got the direct lenders, you got REITs, insurers, you got the global banking centers, of course, all inside of there. And look, let's take a look at what happens here. If you take these 62 stocks and put them together, equally weighted, that's a key thing there, you get a dividend yield of 2.96%. So those 62 names total will pay you 2.96% for owning the package, right? So you've got to own the 62, you'll get paid almost 3%. Now, you might think, that's not really worth it, right? Like to get paid 3%, isn't this sector sort of really weak? That's not too bad. If you think about the sector has already lost 17.96%. Remember, any discount fund manager, any guy that's looking for something that's depressed, it's already going to have lost some amount. So we're pushing 20% probably as of today that the financial portfolio, we'll call it, I don't know what you want to call it, the financial depressed group or something, down close to 20%. So if what you hope is the bulk of everything that's sold off, now it's in bear market territory. If that's happened and now you're going to get 3%, hey, that might not be too bad. What if it falls 25% or something? Then your net loss is only 2%. So you've got something here that may be highly discounted, but that's still going to pay you guys right there. Have I lost you? Are you with me? You get that so far? So let's pretend that that's what we're doing here. We say, all right, we're going to build this portfolio, 62 names. It's going to give us a 3% dividend. It's already sold off close to 20%, so it's highly discounted. Doesn't mean it can't go down 30% or whatever, but we've already missed the bulk of the decline. Is it worthwhile? Now what the fund managers are going to do is take it a step further and say, okay, could we sell this to our managers? Could we go back and sell this idea of buying a custom financial portfolio to these guys? And the answer is going to be, tell us how it moves. You know how I talk about speed, right? We don't want to buy something that's selling off only to find that it's not going to recover as quickly with the market. Stay with me here. So if you have the market recovering, right? Let's say the market's going 100 miles an hour. You want something that recovers faster if you're going to buy falling areas of the market. If you're going to follow a trend and buy things that are already headed up, utilities and healthcare, you don't necessarily need to move faster than the market because you've got that tailwind, and so that's not going to be a criteria for them. But to take the risk of buying something really weak, there has to be an expected increased reward on the upside. Well, if you actually equally weight these and you buy them all together, and the market's moving at 100 miles an hour, you have just built a portfolio that's moving at 115 miles an hour relative to the sector, right? 1.15. If for some reason relative to the market. So the market's moving at 100 miles an hour, you're going to be moving 115. What does that mean? Like, what's so interesting about that? Well, it means that your risk buying a depressed area of the market, getting just a little dividend there, 3%, is potentially going to pay off faster than the market can recover. It's not a guarantee, of course. That number does change, by the way, but it gives you the idea that you're not just going to recover with the market. In exchange for that risk, you might recover faster than the market. In fact, if you look at the sector, how much faster will this group of stocks recover relative to the sector? It's 1.28. Sorry about that. That's a 2. All right? So now you know that if the financial sector starts to recover, your portfolio here that we're pretending is a fund manager, going with this portfolio, your portfolio will move faster than the sector. I told you we were going to get geeky today, right? I told you we were going to do it. So that's how you can kind of weigh the pros and the cons. Remember, you're going to be moving faster and you'll still get the dividend on the way back up. So you're taking the risk of buying something that's on sale. You're getting rewarded more on the way up should everything recover. You're getting a little dividend in the meantime for your efforts and for holding those stocks, and you're going to move faster. Did I ever say that? You're going to move faster on the way up. Now, just for fun, what I did is I put the 62 names together today and pretended that today was the day we bought them. Equally weighted, put them all in one group. So just for fun, I will follow up with our customers if you're interested so you can see how this recovers. We'll use our Thursday night classes to measure the recovery rate, see if all of this starts to become true on the way back up. I'm not making it as a recommendation, of course, to tell you to do it, but I'm just showing you how people look for discounts. Don't look at the financial sector and say, oh, it's beaten down. It's not interesting. You can't make any money there. You can make money if you go about it sort of smartly. Now look, that's equal weighting. If you said, I want to put a little extra weight towards some of the faster names, meaning I might do 1,600, 2,000, 2,000, 2,000 towards some of the heavier names, right? Not equally buy them all the same, but buy some of them heavier than others. Now all of a sudden you can increase your dividend a little bit, you can increase the speed, and so that sort of balance, that's what we do for our customers at Jazz Wealth. All the portfolios on our page have a goal in mind with a certain speed. And so we look at that and we go, okay, our dividend fund, there's 100 stocks in that dividend fund. Could we sort of tweak it a little bit and squeeze a little more out there? Yeah, we can if we make certain adjustments. That's all these guys do. And that's where they're going to find the opportunity going forward. So again, nothing wrong with buying a trending sector, healthcare. You could do the same thing in healthcare, by the way, build something interesting and then consider that your packaged portfolio. Just like on our website, we have dividends, we have REITs, we've got aggressive stock portfolios, we've got large cap, small cap. We put them together in a way just like that so that you can see an expected return or expected growth over the long run there. So you could do it on that side. You could do it on the discounted side, and that's why, like when people say you never buy like dropping stocks or whatever, yeah, you don't buy them individually because you don't know, like Goldman Sachs, new lows today. You don't know if Goldman Sachs is going to turn around somewhere in a respectable area, so you buy a bunch of them. You put a package together. That's how people invest. Put a package together and make that package one single vehicle so that you know what you can expect out of it going forward there. All right, I hope that helps you. I figured I would try to make this one a little bit short so that, because I know it was a little bit geeky. So throw into 62 different entities with potential positive outcome for a near guaranteed benefit. Well, I won't use those words. Yeah, I won't use in those words, but it's just an idea of how to say, here's an opportunity of a discount. There's no guarantee it's going to bounce, but here's somewhere that's depressed. How do I invest in that? It's like if you go into an area of town where real estate is depressed. You're not just going to pick off one house on one street. You're going to kind of like look around and go, should I like spread it out a little bit? And then if this thing recovers, is there a Starbucks coming in? Like, where's my tailwind? What's going to happen? I need to limit my risk. It's sort of similar to that. That's one way to do it anyways. Goldman Sachs new lows every day. Seems like it, right? We're going to cover all that on the closing beat today because there's a lot of, what do you call it? A lot of extension out there, if that's a way to say it. Robert, yeah, we're referring to your portfolio beta weighting, as well as in this channel we did, as well as this study we did the sector weighting as well, if that helps you. Just in case someone's like trying to, because think about it this way, if you buy a package of financial stocks, do you really care what the S&P does? No, you care what the sector does, the financial sector. So in that case, your benchmark would be against the financial sector, because imagine if I'm a fund manager and I just laid this whole case out to you and you're my manager and you said, okay, tell you what, you can allocate so many dollars towards your portfolio that you think is going to do well. I go, okay, great. And then the manager is going to say, but we don't care what the markets do. We care what the financial sector does. We want to know if we would have just been better off buying the sector as a whole. That's your sector weighting over here. So as a as the fund manager guy, I'm going to go, great, I got 1.28 here, we figure 128 miles an hour relative to the 100 miles an hour. Cool. I should be able to beat the sector. Therefore, when I respond back to my manager, I'm going to be able to say it was worthwhile. That effort, the time that you put into there, was worthwhile. So, Robert, that's sort of the longer answer there. Look, I know today's video wasn't for everybody, but sometimes we just need to stretch the brains out a little bit. You just need to do a little extra work in there. So I really enjoy putting these things together when I get a chance. Thanks, Mark. I appreciate it. I thought about doing a giveaway, Mark, maybe for a series of giveaways. We might start that next week. We got a little behind here, but we'll see. Anyways, for stock market update later at 5 o'clock, we'll do a complete update. We call it the closing beat. That's our 5 o'clock show where we go over the stock market, the good, the bad, and the ugly, of course. And so we'll be sure to conquer that for you. Yeah, if we helped you in some way, hit the subscribe button. I'm all out of words for the day. So I'm going to wrap it up there, and you guys enjoy the rest of your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.